I am in shock. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, it's an emergency alert as all hell breaks loose. And if you think this is about the stock market, well, for one country, as you're about to see, the stock market is about to be the least of their problems. And how would you like to make a quick 25% return? Well, I'm going to show you an incredible chart set up from our sponsor of today's show, Safe and Green Development Corporation. You can find them on the NASDAQ under the symbol SGD, and they build strong, innovative, and green single and multifamily projects. And what has happened with their stock is setting up an incredible move that you don't want to miss out on. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where we find out that all hell is breaking loose in the Eurozone as growth grinds to a halt on surprise German slump. Now this is something that we predicted on the show what happened, but what do we continue to hear from the political elites around the world is there's going to be a second half rebound, and we warned on the show that if there's any signs of a rollover in the economy, look out. It means things are going to plunge to the downside. And now in Germany, it's setting up the worst of all possible scenarios. And while Germany's manufacturing malaise worsened again, and this was warned that the economy might contract in the third quarter, but not everyone is downbeat. And I want you to see that while there's some like me who say this is going to get worse, there are others that believe the complete opposite. I'd say the Germany economy has found its footing. This from the Deutsche Bank chief financial officer. We're seeing growth now. It's marginally positive, but we think accelerating now in the second half and into 25. But the odds of that now are virtually zero. When I show you the data, it's going to look far worse than you can imagine. And any sign of an economic recovery, well, that is not going to happen. But one thing we do think is going to have a huge boom is the stock for our sponsor today show, Safe and Green Development Corp. You can find them on the NASDAQ under the symbol SGD. And I want you to see here, you notice when it hits these little bottoms, it pops up. Well, right now, it's done that once and twice down here and setting up a move to this 41 cent level, which is its volume profile line. I'm going to give you some more charts to show you why the buyers are coming in underneath here and why this is a very quick and simple move, one that you don't want to miss out on, because something that people want to completely avoid right now is the German economy. Look at their manufacturing PMI. It's down to 42.6, and this is depression level data, my friends. So when you get under 45, you're in a danger zone, and then you continue to head into contraction, and there's no coming back for this. But what we continued to hear was that the services sector was going to pull the global economy up, but now things have changed in a major way. Check this out. Total inflows of new business, meanwhile, fell across Germany's private sector for the second month in a row. Again, the decline owed exclusively to weakness in manufacturing new orders, which registered the steepest rate of contraction for 3 months. The service sector new business rose for the fourth month in a row, although the rate of growth was the weakest in sequence amid a renewed decline in new work from non-domestic customers. So here you can see the lifeblood of the manufacturing sector is new orders, and it's absolutely plunging. Now, when this happens, the first thing employers do is they shift work to the existing backlogs. But watch out, there's a problem there too. As backlogs of work continue to fall across both sectors during July, and furthermore, the extent to which overall outstanding business decrease was the most marked since February, as rates of depletion accelerated in both monitored sectors. With firms completing orders at a faster rate than they received them, staffing capacity was scaled back for the second month in a row. And this is exactly what happens. You start to see new order growth decline. Workers get shifted to backlogs. And when those backlogs run out, well, next thing you know, you have idle workers. So what employers do is they cut hours and then they cut jobs. And if it doesn't get any better, well, it means more people are gone, and there goes your economy. The decline in employment continued to be led by the manufacturing sector, where workforce numbers posted the steepest drop since March, but July also saw services firms join their good-producing counterparts in cutting staffing levels to end a 6-month sequence of job creation in the sector. This is the steepest decrease in employment since August 2020. So here we're not seeing that mythical soft landing or the second half rebound. We're about to head into a global recession. We know it's going to come down to either Germany or China leading the world down, and you can see what's happening in the U.S. stock market today is just a reflection that global demand is tumbling down. And here's the big issue. This is a big problem. As turning to prices, July's flash data showed a modest uptick in the rate of input cost inflation to a 3-month high. Operating expenses in the services sector increased at a slightly quicker pace, while the drag from falling manufacturing purchasing costs eased as the rate of decline slowed for the 7th time in the past 8 months to the weakest in a year and a half. But the bottom line is average prices charged by businesses in Germany, they increased at a pace that was slightly below their historical series trend. And the reality is they're increasing at a time when manufacturers are cutting hours, they're laying off, and this spells outright doom for the German economy. And where they go, China's going to follow the rest of the world not too far behind. Because let's look at some U.S. data here. We have the consumer price index shown in blue on a year-over-year rate of change. And let's look at what happens when prices are rising. At the same time, you see unemployment claims head higher. Now we can go back into the 1970s and you see they both rise at the same time. And next thing you know, they come pummeling down as inflation just gets wiped out. That happened a second time coming into the early 80s, but then they get more into sync in the 90s as the global economy starts to get into its early kind of years of working together. You'll notice rising unemployment claims met with rising prices. You get a recession. And then in 2000, we had something called the dot-com bubble because stocks were overvalued. Of course, the problem today, as we know, the big mega cap 5 are more overvalued in terms of concentration than ever in history, setting up another potential bubble in equities to burst. And then look what happened by the global financial crisis, the same scenario. And you'll notice that each and every time inflation comes crashing down as the economy heads into a recession. The U.S. not quite at the same stage that Germany is, but what this is indicating is that the German economy is headed into a recession. There's no question now, and all hell is about to break loose there, because as German workers hit the unemployment line in larger numbers, watch for the rest of the Eurozone to collapse right behind them. And yet the ECB speak has increasingly raised concerns over near and medium-term risk to growth outlook, as they should, because literally the core manufacturing base of the Eurozone is crumbling. But if the data today translates into weaker growth figures, this could strengthen the resolve for a September rate cut. And it does. The problem is it's only likely to be one cut. And the issue is they need to do a whole lot more than that, because what we know is that central bankers always respond with a lag and always too late. The Bundesbank already cautioned this week that second quarter growth was probably weaker than anticipated after disappointing industry data. It still said, and look at this, I want you to believe that the central bankers are convinced as momentum should pick up in the 3 months through September on the back of stronger private consumption. But if people are losing their job, they're not going to consume, and that's the bottom line. Though it cautioned that things will only improve slowly in manufacturing, but it doesn't appear to be the case. As people lose their jobs, they spend less, and as other people see their friends and family and coworkers lose their job, well, they turn around and spend less as well. And all this means is the hope of the services sector. Well, if the services sector follows the manufacturing sector down, usually with approximately a 3-month lag. And we can look here at the Philly Fed General Business Index for the manufacturing sector against advanced retail sales. And we've got a lot of data here that shows slowdowns in manufacturing. When they start to see a slowdown in retail sales, it's game over. You're going to see both of them sudden plunging, and that's what's happening in Germany. You see that happen here again in the dot-com bubble, and look at the global financial crisis. Manufacturing started to turn down, and then you see, of course, retail sales follows with a lag. This time, we see hope in the U.S. side that manufacturing's okay. It's not as good as the Philly Fed shows. I'll show you here in a bit, but as demand for retail sales continues to slow, well, that means, of course, retailers aren't going to buy inventory, wholesalers aren't going to buy inventory, and that means, of course, new order growth goes down, and next thing you know, U.S. manufacturers cutting jobs as well. But Europe's extended factory slump puts a chill on rebound and hopes. That is just the wrong word. It's putting it on ice because there's no chance of a rebound here. And according to David Powell of Bloomberg, the decline in both manufacturing and services, this suggesting the country, referring to Germany being worse off than France, is having to cope with a depressed industrial sector and the anticipated recovery in services from a boost in inflation-adjusted incomes, which appears to be delayed. It's because it doesn't work. You know, they give people raises, which is wonderful, but it only has a short-term effect on the economy. And while you can boost real wages, as other people lose their job and hit the unemployment line, their spending drops at a faster rate. It's just game over for Europe and potentially coming soon to America. As U.S. business activity expands by the most in more than 2 years, but this on the services side, you see the flash PMI edges up to 55 from 54.8, suggesting further expansion here in the U.S., which has been good news, but the market's response today was not so much. An index of new business and services providers improved to the highest level in a year, and this could be a seasonal effect, which is highly likely that we expected during the summer months. Today we saw large draws in gasoline and distillate inventories, and it makes sense in the summer that you would expect to see the services sector turn around here. But yet, look at this. The report points to an economy that continues to grow at the same time companies have limited capacity to pass on higher costs. Now, when a company can't pass on higher costs, there's something else they can't pass on, and that's higher wages. And so the challenge then becomes, if energy prices stay elevated and interest rates stay elevated, on top of the back of, if we see higher insurance rates, U.S. consumers just do not have the pay increases to keep up. It's only a matter of time before they drain out what's left on their credit cards and other forms of credit, and then the U.S. economy is going to soon look like Germany. And here we can see the S&P Global Flash PMI fell from 51.6 to 49.5. This is the manufacturing sector here for the U.S. in July, and that means we're back in contraction, although very slight contraction. But look at what's happening. A decline in new orders, which backs up the fact that we're seeing this slowdown in retail sales as a slowly backfeeding into the manufacturing sector, which means production and inventories contributed to the decline. Well, if you don't have new orders and you don't have enough backlogs, your production's going to go down. That makes perfect sense. A reduced rate of employment growth also acted as a drag on the PMI. Again, this is all following the path that's being set forth by Germany. Supplier delivery times, meanwhile, lengthened marginally, acting as a positive influence, but that was only marginal. And here we turn to other problems in the U.S. economy. And when you see a slowdown, well, it means people are going to spend less. And I want you to see here how this article kind of spins the situation. But it's very evident as you see more and more people hit the unemployment line. You hear people at work saying, hey, their hours are getting cut. They don't have a lot of work. It starts to create a little bit of anxiety across other people, and their spending naturally goes down. And this is a big one because the housing market is key to the U.S. economy, and now we're seeing home deals fall apart at a record rate for June. This according to Redfin, as sellers are now cutting their asking prices, which is an absolutely shock move. And nearly 56,000 home purchases were canceled last month, equal to about 15% of homes that all went under contract. So imagine this. You sign a contract to buy a home and you walk on it. And this is a huge issue, but I want to see how they spin this. And that's the highest share of cancellations for June in the brokerage's data for Redfin going back through 2017. and buyers are getting more and more selective. I don't think that's the issue. They're backing out due to minor issues because the monthly costs associated with buying a home today are just too high to rationalize not getting everything on their must-have list. But that doesn't make sense. Are people out signing contracts without looking at what they're buying? Here's the real issue. They want to buy a home, and next thing you know, they're finding out that things at work are not what they thought, or they're seeing things happen to their friends or their coworkers, and they're seeing the economy change, and they're backing out of fear. The economy is going to change, and they're going to be out of work and not be able to afford that house. New U.S. home sales unexpectedly declined to a 7-month low. So it's not just the resale market. Contract signings have eased 0.6% in June to 617,000 annualized rate. But this should not be a surprise. Well, it's not to us, because what we see is home buyer confidence has collapsed to an all-time record low. And so it's not just a matter of people not finding the home they want, because there's plenty of inventory in new homes that are out there. The issue is the economy slowing down. People are losing confidence, and that means the U.S. economy is soon to be down the path of Germany. Of course, that means China's going under as well. And next thing we're going to see is a world marred in a global synchronized recession. And we're going to see a lot more headlines like this, where the Bank of Canada cuts to 4.5%, shift focus to downside risk. We're going to see a lot of central banks doing more than just 1 or 2 cuts. They're going to be aggressively dropping rates, and at that point you're going to see equity markets start to unwind, and you're going to look for investors to find fantastic short-term opportunities, like the stock for our sponsor of today's show, Safe and Green Development Company. They are on the NASDAQ under the symbol SGD, and again, we're going to review that chart and some other ones, show you how you can put a quick 25% in your pockets. They are a real estate development company formed back in 2021, focused on the development of sites using purpose-built prefabricated modules built from both wood and steel. The thesis of development is to build strong, innovative, and green single or multifamily projects across all incomes and asset classes. And we're talking about industrial complex, we're talking about small residential projects, and even much larger ones. And this is really cool. And here you can see Safe and Green Development Corporation just joined a $400 million Pigmental Studios development, and they were thrilled to announce their participation in the Pigmental Studios development project set in St. Mary's, coastal Georgia. While the property is currently in the process of closing, SG DevCo is committed to collaborating closely with Pigmental Studios to ensure the success of this groundbreaking endeavor. And the project is intended to impact the entertainment industry by providing state-of-the-art infrastructure and resources for the production of high-quality media content in the live action, visual effects, animation, and immersive storytelling experiences. SG DevCo will bring their expertise in sustainable construction practices, aligning with Pigmental's vision for this development project. And the CEO of SG DevCo expressed his excitement about this collaboration, stating, "We're honored to participate with Pigmental Studios in this venture. As a significant part of the team, we'll participate in creating this world-class production studio that not only contribute to the growth of the entertainment industry in Georgia, but specifically prioritize sustainability. This collaboration showcases the strong working relationship we built with Pigmental and our shared commitment to responsible excellence." And of course, we look to the CEO of Pigmental Studios, who also shared her enthusiasm for the collaboration, saying, "Adding SG DevCo to our team is a crucial step toward realizing our vision for Pigmental Studios development. With their experience in sustainable practices, we're confident this project will be set thoughtful standards in the industry, and we're excited to work together to provide a viable, sustainable, aesthetic, and collaborative functional campus for artists and storytellers." And this is setting up a huge opportunity in their stock. Now, I want you to see this red line that goes across your screen. This is a 21-day moving average. And I want you to know is when the stock price moves well below it and gets into what's called oversold territory, you'll notice that volume picks up and the stock jumps. And usually it jumps over it, but you can see every time it pulls back below it, moves right back up into trend. And now we see a big drop here, setting up and move higher over the last 2 days, which is likely to turn into a 25 or possible higher jump in their stock price. Let's take a zoom in look here to the 10-day chart, and what you can see here is buyers have stepped in on this pullback, and you can note that once the sellers are exhausted, the buyers tend to jump the stock up, creating a huge opportunity. We think it's just a 25% move, but if it jumps up here into the 50-cent level, it could be worth a whole lot more. But what we know is this is a short-term opportunity you want to jump on very, very quickly, because look at this. You can see on the 1-day chart, buyers are underneath here in a big way. Even as the broad equity market sells off, they're looking for other opportunities. Safe and Green Development Corporation on the NASDAQ under symbol SGD is one of those where you can look to make a potential 25% news move. Check them out again on the NASDAQ under symbol SGD. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.